Passive income has one of the best names in money. It sounds clean, calm, almost unfair. You build something once, money keeps showing up, and eventually you stop trading your time for a paycheck. That is the promise. The strange part is that most people chasing passive income look exhausted. They're answering customer emails at midnight, repainting rental units between tenants, uploading videos every week because the old ones stopped getting views, checking sales dashboards, chasing contractors, updating a course nobody can find anymore. So yes, passive income exists, but usually not in the form being sold to you. Here's the first thing nobody says clearly enough. Passive income does not remove work, it moves the work. Sometimes the work happened years earlier. Sometimes somebody else is doing it and you're paying them. Sometimes your money is doing the work, which means you first had to earn and save a lot of money. And sometimes what looks passive is simply risk sitting quietly until something goes wrong. Even the tax code is a little misleading. The IRS generally classifies rental activity as passive unless certain real estate professional rules apply. That's a tax category, not a description of your Tuesday. So let's stop asking whether an income stream is passive. That question is too vague to be useful. A better question is this: what did you have to put in before the money came out? Capital, upfront labor, ongoing maintenance, risk, and time. Every so-called passive income stream charges you in some combination of those 5 things. Start with the cleanest version: income from investments, dividends, interest, a broad stock fund, bonds, cash in an interest-bearing account. This can be low effort. You buy the asset, hold it, and payments arrive without customers, shipping, or broken toilets. But the work is hiding inside the capital. Suppose you want $5,000 a month. That's $60,000 a year. At a 4% annual income rate, you need about $1.5 million invested before taxes. The payment is passive. Getting the $1.5 million probably was not. And the income is not guaranteed. The SEC warns that funds can lose value, distributions can change, and fees reduce returns. A company can cut its dividend, interest rates can fall. An investment that pays a high yield can lose value faster than it pays you. Maintenance is low. The capital requirement is brutal. That's the trade. Now, rental property. This is where the word passive starts getting stretched. Rent does arrive without the owner clocking in every morning. Fair enough. But rent is gross income. It's not the amount the owner gets to keep. There's mortgage interest, insurance, property tax, vacancy, repairs, management, legal work, and the big expenses that do not arrive politely every month. A roof does not cost 1% a year. It costs nothing for a while, then suddenly costs $12,000. The IRS lists maintenance, insurance, taxes, interest, management expenses, and depreciation as part of the rental calculation. It also makes clear that mortgage principal is not simply deducted as an expense. So, when somebody says, this property makes $3,000 a month, slow down. Does it collect $3,000 or does it make $3,000 after everything? Those are completely different sentences. A rental can become fairly hands-off if the numbers are strong enough to pay a competent manager and still leave a profit. But notice what happened. The work did not disappear. It was outsourced. The owner pays somebody else to take the calls, screen tenants, collect rent, and coordinate repairs. The owner still carries the financial risk when a unit sits empty or the plumbing fails. Rental income can be good. It just isn't magic. Then there's the online version. Write an ebook, build a course, sell a template, create software, record music, make videos that keep earning years later. This sounds better because there's no building to maintain, but digital assets have their own maintenance problem. Attention decays. A course gets outdated. A template gets copied. Search rankings change. Platforms change their rules. An old video may keep earning because the channel around it is still alive. YouTube says creators who accept its watch page monetization terms receive 55% of net advertising revenue from ads shown on eligible public videos. It also says there is no guarantee about how much or whether a creator will be paid. That second sentence matters more than the first. A video earning money while you sleep sounds passive. The years spent learning to write, record, edit, package, publish, and build an audience were not. Books work the same way. Amazon's Kindle platform offers 35% and 70% ebook royalty options, depending on price, territory, and other conditions. The book can keep selling after the writing ends, but it still needs discovery. Nobody tells you that the product is only half the job. Distribution is the other half. Royalties are similar. A song, book, or piece of software can earn long after the original work is done. One piece of work can sell many times. But the payment system is rarely simple. Spotify says it doesn't pay a fixed amount per stream. Payments depend on stream share, market, rights ownership, and agreements with labels, distributors, publishers, or collection societies. So the creator may own the work and still sit at the end of a long payment chain. The income is real, the simplicity is exaggerated. Now look at the so-called passive business, a laundromat, vending route, car wash, online store, small company run by employees. This is usually the point when somebody says, "I don't work in the business, I work on the business." Sometimes that's true, but a business becomes less dependent on the owner after systems, staff, reserves, training, and controls are in place. Someone hires the manager, watches the numbers, and replaces that manager when they leave. And when revenue drops, the employees still expect to be paid. The owner may avoid daily labor, but still holds the risk. Ownership is supposed to carry risk. The problem is pretending risk is free income. So, what actually counts as good passive income? Not the thing with the least visible work, the thing where the hidden cost makes sense for you. If you have capital but very little spare time, diversified investments may fit. If you understand a local property market and can manage people and repairs, a rental may fit. If you can create useful information and already know how to reach an audience, digital products may fit. If you're good at operations, hiring, and controls, a business may eventually run without your daily presence. But if you copy somebody else's model without their advantage, you usually inherit the work and miss the income. There's also a timing problem. People often compare a mature income stream with the beginning of their own journey. They see the landlord after 10 years, not during the first vacancy. They see the creator's old videos earning money, not the first 100 videos that barely moved. They see the business owner leaving at noon, not the years that owner opened the doors, closed the doors, covered payroll, and handled every mistake. Passive income is often active income that survived long enough to become efficient. That's a less exciting promise, but it's much closer to the truth. And there's a useful way to judge any opportunity before you put money into it. Ask 5 questions. How much capital does it require? How much unpaid work happens before the first dollar arrives? What maintenance remains after the system is built? What can go wrong and who pays when it does? And if you stop touching it for 6 months, does the income continue, decline, or collapse? That last question exposes almost everything. If the income disappears the moment you stop posting, it's not passive, it's a job with delayed payments. If the property falls apart when you leave, you didn't build a system, you built a dependency with your name on it. And if the investment income looks impressive only because the underlying asset is unusually risky, the yield may be compensation for danger, not a gift. The truth is, there's no shame in active income. Active income is usually where the capital comes from. It pays the bills, funds the investments, buys the property, gives you time to build the product, covers the early years when the business is still unstable. The mistake is treating active income like the enemy and passive income like escape. The better goal is not to avoid work. It is to make today's work continue paying tomorrow. That might mean owning assets. It might mean building systems. It might mean creating something once that people can buy repeatedly. But every one of those paths asks for a sacrifice before it offers freedom. Money, time, skill, patience, risk, usually more than one. So yes, earning money while you sleep is possible. But first, you normally have to do something valuable while you are awake. And even after the income becomes quieter, somebody is still maintaining the machine. Maybe that person is you. Maybe it is an employee. Maybe it is a platform. Maybe it is your capital sitting in the market and taking the risk for you. Passive income is not money without work. It is money produced by work, capital, or risk that has been separated from the moment you get paid. Once you understand that, the whole subject gets less glamorous and a lot more useful.